Did you know you can use your investment accounts to lower your tax bill? My name is Mike Heatwall, and I am the founder and CEO of the Dala Group, a wealth management firm focused on helping retirees. In this video, we will dive into a powerful strategy called tax loss harvesting that can save you money the next time you file your taxes. So, what is tax loss harvesting? Simply put, it's a strategy in which you sell investments that have lost value to offset the capital gains you have made on other investments, or to offset your ordinary income. This strategy is especially useful when the market is down because it allows taking advantage of losses for tax purposes without sacrificing the long-term gains from staying invested. Here are the top 3 benefits of tax loss harvesting. Number 1, lower taxes. You pay less in capital gains tax. Number 2, capital loss carryforward. If your losses exceed your gains, you can carry forward the remaining loss to offset gains in future years. Number 3, offset ordinary income. Up to $3,000 of excess losses can offset your ordinary income each year. Let's look at a simple example to understand the first benefit of tax loss harvesting: paying less in capital gains tax. So imagine you bought Apple and GE. After some time, Apple increased by $10,000, but GE dropped by $4,000. If you only sell Apple, you would owe taxes on the $10,000 gain. Assuming a 15% federal capital gains tax rate and a 5% state capital gains tax rate, the $10,000 gain would result in a $2,000 tax bill. But by selling GE at a loss, you can offset the gain from Apple by $4,000, meaning you are only taxed on $6,000 instead of the whole $10,000. The $6,000 gain would result in a tax bill of $1,200. So by selling GE, we have saved $800 in capital gains taxes. Let's look at another example to understand the other 2 benefits: capital loss carryforward and ordinary income offset. So again, let's imagine you bought Amazon and Home Depot. After some time, Amazon remained flat, but Home Depot dropped by $4,000. You will realize $4,000 in losses if you sell Home Depot. We can only offset a maximum of $3,000 from ordinary income, which is a fancy way to say income from your job or other taxable income such as interest and dividends. So assuming a 22% federal tax rate and a 5% state income tax rate, the $3,000 reduction in ordinary income saves you $810 in taxes. Since we've used $3,000 of the $4,000 available, we're left with an additional $1,000 of losses for next year. These losses will be carried forward and then can be used to either offset next year's ordinary income or capital gains. Now, how do you implement this strategy? So step 1 is review your portfolio. In this first step, we look for investments that have declined in value and that we believe have an equivalent alternative. For example, if we're invested in a small cap index fund that has declined, and there's another small cap index fund we believe will perform similarly over time, we can sell our current investment for a loss and immediately replace it with the second index fund. Another example is if we're invested in a company such as Visa, and there's an equivalent competitor we believe will perform similarly, such as MasterCard. Step 2, sell losing investments. To realize the loss, sell the investments you identified in step 1. Step 3, reinvest. After selling in step 2, reinvest the proceeds in the alternate investment you identified in step 1 to maintain your market exposure. Step 4, file your tax return properly. When tax season rolls around, ensure you report your capital gains and losses properly on your tax return by incorporating the information on the 1099-B. The custodian will provide this form. So this is a good spot to stop and discuss a critical IRS rule called the wash sale rule. This IRS rule prevents you from claiming a tax loss if you buy the same or substantially identical investment within 30 days before or after the sale. If you ignore this rule, you may find yourself in a spot where you sell an investment at a loss but cannot use the loss for tax purposes. So let me walk you through a quick example of what would be considered a substantially identical investment according to the IRS. If I am invested in the Schwab S&P 500 index and want to sell this investment at a loss for tax purposes, I cannot immediately reinvest into the Vanguard 500 index or the Fidelity 500 index, as these indices have the same underlying investments. In this case, I would also be careful about investing in any other ETFs or index funds meant to track the S&P 500, even if they don't have S&P 500 in the name of the investment. An alternative could be selling the Schwab S&P 500 and replacing it with the Schwab Total Stock Market Index. While they invest in similar underlying investments, the Total Stock Market Index includes small cap companies, so they are different enough to avoid the wash sale rules. Tax loss harvesting can be a game changer for your tax bill, but in our opinion, should only be used as a long-term strategy. Don't just sell off your investments for a quick tax break. Make sure there's an equivalent replacement and that it fits within your overall financial plan. If you found this information helpful, please give us a thumbs up and don't forget to subscribe for more financial insights. Thanks for watching, and we'll see you next time.